How do changes in government spending affect interest rates? In today's economic climate, many are asking how changes in government spending can influence interest rates. This question is especially relevant as governments around the world are adjusting their budgets to respond to various challenges. Just last week, we saw significant discussions in the United States about fiscal policy and its implications for the economy. If you are curious about how these decisions impact your finances, you are in the right place. When the government increases spending, it has a direct effect on the economy. This is primarily because such spending raises the overall demand for goods and services. For instance, when funds are allocated for infrastructure projects, it creates jobs and stimulates economic activity. This increase in demand can lead to higher economic growth, but it also raises the demand for credit. To finance this increased spending, governments often borrow money by issuing bonds. This action raises the demand for loanable funds in the financial markets. As a result, when more people and businesses are seeking loans, the competition for available funds increases. In the short term, the supply of funds remains relatively fixed. Therefore, this heightened demand tends to push interest rates higher. Higher interest rates mean that borrowing becomes more expensive. This can have a knock-on effect, making it harder for businesses and consumers to secure loans for investments or purchases. This phenomenon is known as the crowding out effect. Essentially, when the government borrows heavily, it can crowd out private sector borrowing. This means that businesses may find it more difficult to get loans, which can slow down private investment and consumption. Central banks, like the United States Federal Reserve, also play a role in this equation. They influence interest rates through monetary policy. If government spending leads to inflationary pressures, the central bank may decide to raise policy interest rates. This action is intended to cool the economy and keep inflation in check. Conversely, during economic downturns, the central bank might keep rates low to encourage borrowing and spending. Recent economic data shows that the United States Federal Reserve held interest rates steady between 4.25% and 4.5% in July 2025. This decision reflects a cautious approach as the Fed monitors how factors like tariffs and fiscal policy affect inflation and economic growth. Some economists predict that if growth slows, there could be rate cuts in the future. However, inflation continues to be a significant concern. In summary, an increase in government spending generally raises interest rates by increasing demand for credit. The final impact, however, depends on the response of the central bank and the overall economic conditions. Conversely, reducing government spending can lead to lower interest rates by decreasing borrowing demand.